Investing in index funds, a beginner's guide. An increasingly popular investment strategy among novice and experienced investors alike is putting money into index funds. Index funds are investment vehicles that track the performance of specific financial market indices, such as the S&P 500 or the Dow Jones Industrial Average. This guide aims to offer a comprehensive understanding of index funds to beginner investors, outlining the key principles, advantages, and strategies related to index fund investing. Understanding index funds. Index funds are a type of mutual fund or exchange-traded fund, ETF, designed to replicate the performance of a particular financial index. By investing in an index fund, you're essentially buying a tiny piece of each company or asset that comprises the index. This strategy aligns with the principle of diversification, spreading risk across a broad array of securities instead of focusing on a single stock or bond. Index funds can track a multitude of indices, including but not limited to large cap stocks, S&P 500, small cap stocks, Russell 2000, international stocks, MSCI EAFE, bonds, Bloomberg Barclays US Aggregate Bond Index, and sector-specific indices, like the NASDAQ 100 Technology Sector Index. The advantages of index funds. Diversification. Index funds provide broad market exposure. Instead of betting on a single company or sector, you're spreading your investment across a large number of companies or assets. This approach reduces the potential impact of any single security's poor performance on your overall portfolio. Low costs. Index funds are passively managed, meaning they aim to mimic the performance of the underlying index rather than actively trying to beat it. This strategy results in lower expense ratios compared to actively managed funds. The cost difference can significantly impact your returns over the long term due to the power of compound interest. Accessibility. Index funds typically have low minimum investment requirements, making them accessible to investors with various budget sizes. Additionally, they're available on virtually all investment platforms, providing easy accessibility to the average investor. Transparency. Index funds are transparent in their holdings because they merely replicate the composition of an index. This transparency allows investors to understand precisely what they own at any given time. Choosing an index fund. While the idea of an index fund is relatively straightforward, there are many different funds available, each with its nuances. Therefore, it's essential to consider several factors when choosing an index fund. Expense ratio. One of the critical factors to consider is the expense ratio, which is the cost to run the fund expressed as a percentage of your investment. A lower expense ratio means you'll keep more of your returns. As index funds aim to replicate an index, paying higher fees doesn't necessarily yield better results. Fund size and liquidity. Larger funds often have more liquidity, meaning you can buy and sell shares without significantly impacting the price. Smaller funds may also be subject to closure if they fail to attract enough investors, potentially causing inconvenience. Tracking error. While index funds aim to replicate an index, they may not always achieve this goal perfectly due to fees and other practical constraints. The difference between the fund's performance and the index is called the tracking error. A smaller tracking error indicates a more accurate replication of the index's performance. Strategies for investing in index funds. Once you've chosen an index fund, you need to consider your investment strategy. There are two main strategies beginner investors often consider: lump sum investing and dollar cost averaging. Lump sum investing. Lump sum investing involves investing a large sum of money at once. If you have a significant amount of money you're looking to invest, and you believe the market will rise over your investment horizon, lump sum investing could be a suitable strategy. Dollar cost averaging. Dollar cost averaging involves investing a fixed amount of money at regular intervals, such as monthly or quarterly. This strategy reduces the risk of making a large investment just before a market downturn. It also eliminates the need to time the market. Risks of investing in index funds. Like all investments, index funds come with risks. The primary risk is market risk, as the performance of an index fund will rise and fall with the underlying index. If the market as a whole declines, so too will your investment. Furthermore, While diversification within an index fund can protect against the poor performance of a single company, it does not protect against systemic market risk. In a widespread market downturn, nearly all stocks could decline in value, irrespective of the company's individual merits. For more videos, like and subscribe our channel. Thanks for watching the video.